Retail investors, well, they're getting a bit scared, at least when it comes to the market. Last week marked the 24th consecutive week of outflows from equity mutual funds. Let's send it over to CNBC's Leslie Picker. She has more on that important story. Leslie.
Hey, David, I want to first show you a chart that tracks the sentiment divergence among mom and pop investors relative to professional investors. And as you can see by that chart here, the orange line indicates that retail investors have been trading with some of the lowest levels of confidence that we've seen this year and well below that of institutional investors, the so-called smart money. Now, why might that be a problem for the broader market? Well, I've spoken with equity trading desks across the street, and they point to this retail selling in mutual funds and perhaps more notably in index funds. And when those funds see redemptions, they need to sell their assets, but only in proportion to how they line up in the index. That makes for little discretion in the selling, which is spooking investors even more and causing them to take more capital out of these funds. And as you can see, the vicious cycle continues. Now, according to Credit Suisse, this pattern first emerged in October, and the firm's prime brokerage unit says it may speak to the persistence of the equity market turbulence, guys.
Interesting, Leslie.
Yeah.
There's also been outflows from bond funds. It almost seems like retail investors are not exactly sure what to fear the most out there.
It's interesting because a lot of people are looking at this market and saying, why now? We've seen these risks. The risks have been out there. The Fed has been increasing interest rates. I mean, you could point to the yield curve inverting, but a lot of retail investors are looking at ways to kind of trade these macro scenarios, and index funds have been the answer to that. Psychologically, it's easier for them to say, you know what, I'm going to take some risk off the table by selling index funds, whether it be in fixed income or equity, than it may say to sell individual names that they have done research and hold affinity to.
It's hard to underestimate the influence and importance of these funds, though, index funds in particular, Leslie, which own as much as, 30 to 40% sometimes.
That's right.
They are enormous holders of equities. If they really were to see significant outflows, it could be a while till we sort of had price discovery at a different level.
That's true. And a lot of people point to the fact that about 40%, based on, whatever estimate you look at, about 40% of the flows are currently fundamental oriented, meaning stock pickers are doing analysis and determining what value they think the stock is worth. That means the remaining 60% are being conducted through passives, being conducted through quant, where there's no real due diligence and analysis of individual companies. They're just trading kind of based on other factors, like whether or not something gets included into an index or whether or not a rules-based algorithm is telling them to buy or sell a certain security. And so a lot of people are pointing to this and saying, when we really do start to see a correction in essence, in earnest, that we could start to see some of the reverse of the different factors that have been driving the market higher in this move from active to passive over the last few years or so.
Yeah, very important to keep an eye on those free riders, as we call them as well.